All right, in this lesson, we're going to go over the worksheet. Now, I can put the worksheet on this board, but then that would get a little bit crazy, or we can just go through your book. So we're going to go through your book. I'm on page 56. I'm going to go through some of the steps. I'm going to skip over things that aren't really that important, but I'm going to go through most of the steps. The first step that we're going to talk about is this idea of allocating your fair value schedule. So this is kind of what it looks like. We start with the fair value and then the actual book value of the company that we acquire. That gives us excess fair value over book value. Then remember that we allocate anything over that book value to the undervalued assets. So we have allocations made to undervalued assets. So if the assets are in the books for $100,000, but they should be $500,000, then $400,000 of our purchase price over book value would be allocated to that asset, and so on and so on. So if we look in our books on step one, it says we started with the fair value consideration transfer. So this is how much we paid Smalls for Big's investment in Smalls. So $2.6 million. Then we notice that the book value of Smalls is $600,000, which means that we paid $2 million over what their book values are. So we're just doing a schedule here so that we know what we've allocated over to each one of these assets. So computers should have been valued at $600, but they're valued in their books for $400. So we're going to allocate $200,000 of that $2 million to computers and equipment. Capitalized software of 1.1. So remember, capitalized software, it was on their books for 100, but it's really worth 1.2. So we're going to allocate 1.1 of the 2 million to that. 700,000 customer contacts were zero in their books. Contracts were zero in their books, but they are worth $700,000 to us. So we're going to allocate 700,000 of the 2 million to customer contracts, and the notes payables were undervalued by 50,000. We're going to step that back up to 50,000. So of the $2.02 million of overpayment, I guess you could say, of book value, $1,950,000 is going to be allocated to undervalued assets. That leaves us a goodwill of $70,000. So those are excess fair values that are not identified with a specific goodwill. Now, just above that in the green boxes, you'll see the entry that was done on Big Net Corporation's books. Okay, so those were the actual entries that were made. Now, on Exhibit 2.6, you're going to see the worksheet. This is the worksheet. This is the worksheet that we would be using. So notice we have Big's trial balance or financial statement numbers there. We have Smalls there. And then the consolidated entries. So step 3 at the bottom of page 57, you're going to see consolidation entry S. So notice in consolidation entry S, what we're doing there is we are eliminated the stockholders' equity of Smalls. Okay? So obviously Smalls is going to have stockholders' equity. In this case, they're going to have stockholders' equity of $600,000. So $600,000. So we're going to eliminate that. How do we eliminate that? We will debit common stock additional paid in capital and retain earnings that are in Smalls. So Smalls has $100,000 of common stock, $20,000 of APIX, $480,000 in retained earnings. So we're going to eliminate that, and that would give us $600,000. So that $600,000 will then go to the investments in Smalls. So investment in investees account will get reduced by $600,000. Now in this case, that investment account was $2,620,000. How do we know? We can look at the green boxes on page 56. So $2,620,000 was the debit. If we're going to reverse that out, we're going to reverse $600,000 because of consolidation entry S. That gets us down to $2,020,000. Sound like a familiar number? That $2,020,000 is the goodwill and the excess amount that we've put to these undervalued assets. So if we flip the page to page 58, you're going to see consolidation A. Consolidation entry A is the consolidation entry that we are going to do to step up the asset. So we're going to get rid of that investment and investees account of $2,020,000. We are going to do that by stepping up the asset's book value. So the book values, as you saw on Exhibit 2-6, the worksheet, you notice that the book value of the, computer equipment is $400,000 on small ports. We need that to be $600,000. How do we get it to be $600,000? We're going to add $200,000. Where is that $200,000 coming from? That $200,000 is coming from the investment in small port companies account. So if you see on Exhibit 2-6, you see $2,020,000, $2,020,000 of that. $200,000 of the $2,020,000 is stepping up the computers and equipment balance. Okay, so how do we know what we're doing? Well, if you look, let's go to computers and equipment. We start with big nets of 1.3. Consolidation means we're going to add, so we're going to add to that 400,000. That gets us 1,700,000. And then we're going to add to that 200,000. That 200,000 is our step-up basis. So notice if we go all the way down, we went from 17 to 1.9. So we're now kind of putting back those asset fair values when we actually purchased it. So as we consolidate, we're going to put those assets back at what they should have been, but we didn't book it because we were keeping two separate books. And we continue to do that. So that's what Consolidation A is. Consolidation A kind of puts up or reallocates those undervalued assets with the excess of fair market value over book value. So that's kind of the mechanics of the worksheets. I know there are 7 steps. I'm not going to go through 7 steps here, but I think you kind of get the gist. The gist is the consolidation entry S, which eliminates the investments or the equity accounts of smalls, and then consolidated entry A, which steps up the basis of all the assets that were undervalued when we first acquired this corporation. And how do we get those numbers? We get those numbers from step 1, which is that table on page 56. That table starts with fair value and then goes to how we allocated that $2,620,000 purchase price. So that gives you an overview of the worksheet. I didn't want to put that on the board, but since you have your book, it's kind of easier to walk you through that. So if you have any questions, let me know, but that should get you through the rest of this chapter.